Treasury Secretary Janet Yellen is railing against the OPEC Plus decision to cut oil production.
She actually told the Financial Times that the move is, quote, unhelpful and unwise. Less than a week after the group announced it'll be reducing its output by 2 million barrels per day. Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela founded the organization. OPEC is currently comprised of 13 member countries. The U.S. is not a member, but relies heavily on many of these foreign countries for oil.
In order for a country to become a full member of OPEC, a country must have a substantial net export of crude petroleum and share similar interests with other member countries. That country must then be accepted by a 3/4 majority of full members, including the votes from all founding members. Joining us now is Matt Reed. He is the vice president of Foreign Reports, a consulting firm analyzing Middle East politics and oil markets. Matt, great to have you. Just to begin with, can you break down the reasoning behind this decision to cut oil production so drastically?
So I think to start, the most important thing to remember is that OPEC agreed on paper to cut by 2 million barrels a day, but the real cut is only going to be about half that because so many of their members are struggling to produce as much as they're supposed to. So really, we're talking about 1 million barrels a day. Now, last week and over the weekend, we heard from more ministers, and what they made very clear is that they're afraid of a serious global recession that sooner or later is going to impair oil demand. What they're trying to do now is kind of pull off this high wire act. What they want to do is almost in real time, lower production as demand starts to fall. So that way they don't have a repeat of previous recessions where suddenly oil demand fell off a cliff and they were left broke.
You know, we know that the U.S. and the EU had tried to push Saudi Arabia to actually, ramp up production to prevent what's happening now. Now we're seeing that this is going to impact not just the U.S., but the world at large. And Secretary Yellen mentioned that this is particularly concerning for developing countries. Can you expand on that, why the impact is so heavy on developing countries?
Sure. Yeah, it's always true that developing countries are going to hurt more when energy prices go up. But I think OPEC recognizes that. I mean, there are some developing countries who belong to OPEC and OPEC Plus. And really, I think what we have to wait for is to see what the price reaction is maybe a few days from now or even a few weeks from now. Because like I said, OPEC is trying to thread the needle here. What they don't want to do is spike prices. Instead, what they're trying to do is put a floor under them. So hopefully, if they succeed in that, or at least by their reasoning, if they succeed in that, then developing countries also won't suffer.
So then how concerned, Matt, should Americans be about rising energy costs?
It's a tough question. It's the right question for right now, and we should be concerned, not just because of, let's say, what's happening to end this year, but also to start next year. So there's a few big kind of developing stories that are all going to come to a head in the next few months. The first of these, of course, is the OPEC cuts, what comes of them, what the ultimate price reaction is. One thing OPEC stresses is that they're not afraid to go back to the drawing board. So if they cut by 1 million barrels a day, and then prices overreact or the market gets too hot, they say that they're going to come back to Vienna, where OPEC is based, and they can change policy if they have to. They can raise production if that's what it comes down to. We might see them do that in the next few months, depending on some other issues. Now, for the U.S., of course, what matters now, a month out from the midterms, is gasoline prices, which are kind of the ultimate bellwether here. The good news is that those should be coming down as refineries come back online and those outages are resolved. So we had an accident, unfortunately, in the Midwest, and then we had some other planned maintenance out west in California. Those at least will be resolved soon, so prices should come down in the near term. But then let's look ahead. Look to the end of the year when the EU is going to impose tougher sanctions on Russia. That could scramble the markets. It could take a lot of oil off the markets, at which point OPEC will have to decide how it's going to react. And then also the other thing to look forward to next year is what's going to happen with U.S.-Saudi relations, and are we going to see serious legislation that undermines the relationship and forces countries that belong to OPEC to reconsider whether or not they want to do business with the United States?
Well, that might be
that's
up to what happens in the
situation.
midterms. Sorry to cut you off there. And precisely the prices have very much to do with how people are intending to vote. But go ahead and wrap up that thought.
Sorry, could you repeat that question?
No, I said I cut you off. If you wanted to wrap up that thought, I said it depends on what happens on the midterms.
And unfortunately for the Biden administration, there's nothing they can really do in the meantime. And they have a month left. There's no magic wand that can be waved to lower gasoline prices. Really what has to happen is these refineries have to come back online. Now, one big question we have looking to next year is whether or not the White House is going to back legislation that would try to outlaw OPEC. That's something we've been talking about here in DC for 20 years now. Right. But we've reached a point where there is really no one in either party who is really willing to second guess or resist that legislation. It could pass later this year.
Well, given such a polarized world, that would surely increase tension. Matt Reed, thank you so much for joining us.
Thank you.